The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hi, I'm Esther Gulius, the tax lady from EG Tax, and this is our hour to talk taxes. And like last week, where we were answering, we didn't take any phone calls because we were answering your emails. I have still a lot of emails that we wanted to get to. So this week, same thing, no phone calls. Next week, we'll be live again with your questions that we'll answer right over the radio here. But in the meantime, we're going to do some deep thinking here on your emails that you sent us. And I'm joined in studio with Tiffany Fabian. Hey, Tiff.
Hey there, Esther. How's it going?
It is good. And Christopher Fabian.
Hello, Esther.
Hello, Christopher. And just, wanted to mention, if you're somebody that thinks that you like people and you love how the law works, then you would love taxes. And we have a tax school that starts in the fall. There's no charge for the tuition. It's absolutely great. It'll make you brilliant with your own tax situation and help you out with finances. And you will learn so much about how the tax code works. And I will tell you, what's coming down the pike here is a lot of changes, because not only did they tinker with PPP and employee retention credits and deferral of FICA and all that kind of stuff. There's all kinds of things that happen in the tax code. Many of you know that you don't have to take your required minimum distribution this year. So there's all kinds of things that we will put into the course to help you to know what's coming up, to know what has passed, and there's no charge for the class instruction. So go to our website at egtax.com and click on that link on there. It talks about our tax school. We would love to have you in class. And if you have any questions, and we're going to do this online for those of you that don't want to be out in the open, or we have safe distancing and health measures if you'd prefer to be in class. I have to tell you, we prefer you to be in class. You learn better. I know at-home instruction to me is not as good, because if you got a question, you have nobody to ask, and they're not looking over your shoulder, where the teachers that we have that are instructors would do a great job to help you. So
what were you going to say, Chris?
I was just going to say that same thing that we're trying to do. We opened up more locations for our school, our online class, to help with COVID, so you can learn and be safe.
Amen. Okay, what do we got?
George says, EG Tax. So I lost my job in April. I've been freelancing since then. I'm not really a business, just picking up odd jobs here and there. The other day, one of my customers asked for a W-9. What is that? Do I have to provide that?
Okay, why don't somebody ruin Doris's day?
Georgia. So that means they're reporting it to the government, how much they're paying you. The W-9 is saying, what is your name and your social security number?
So you're going to have to declare self-employment income.
Whether or not you've gone down to Erie County and registered as a business, or Niagara County, or whatever county you're in, it really has nothing to do with the taxability of the income. Whenever you're holding yourself out to perform a service and you want people to pay you for the services that you perform, it's taxable income, and you are self-employed. So one of these people that is your customer, they're saying, in order for us to deduct it, we're paying you more than $600. We need your information, your social security number, your name and address. And so they're doing the right thing by asking you for the W-9. Your responsibility is to make sure you add up all the income that you've gotten from all sources this year freelancing, and you're going to do a Schedule C. But the good news is you can reduce that income by all the expenses that you incurred to make the money.
That's right. And so that's where bookkeeping comes into play.
Right,
Money
and
in
so this
and money
is
out.
not the end of the year yet. We still have several months left before the end of the year. So if you need help getting your books straightened out so that you do a proper tax return, that's really important because there's two kinds of taxes you're going to pay. You're going to pay income taxes and FICA.
Right. Yep.
Right?
Yep. So depending on your tax bracket, even if you're in the 12%, just to tell you, adding in the self-employment tax, you're looking 27% to the
Right.
federal government.
So if you made $10,000, that's $2,700 you're going to pay in taxes. So you don't want next year to bite you in the butt, so
and
to
George,
speak.
what Esther said is really true. It's not the people who issue 1099s. It's all the income you made. So Esther said a really good point. You want to sit down and add up all the income you made, not just the people who have issued you 1099s.
And I'm going to throw a monkey wrench in there.
Yeah.
Just by the wording of this, it almost sounds like he doesn't want to claim it because it's odd jobs.
Right.
Is he on unemployment? If he's claiming full unemployment and working under the table and now he gets a 1099, unemployment,
mia.
yeah, unemployment may say, wait a minute, we looked at your tax return, you owe us all this money back.
Right. And so that's the other thing. He wants to make sure he gets right with the state of New York. He gets right with the IRS and stop collecting if he's making money on odd jobs. And so he might say to himself, well, then if I can't get my unemployment, then I'm just going to stop doing the odd jobs, which means that if you're ready, willing, and able to work, you're supposed to.
Right.
Right. Yep.
And
So-
even doing odd jobs.
So I would suggest that you come in. We'll help you. There's no charge for a consultation. We'll get you all straightened out so that you're not devastated by taxes next year.
Yep. I've got Mike from Boston. Esther and gang, I've had a bad few months. I did my taxes this year. I owed the federal about $35,000. I owed New York State about $27,000. And that's because I sold a piece of commercial rental property. And my wife passed away. My daughter lost her job. They
Oh my
want to move.
gosh.
They want to move in with me. My life is a mess. Do you have any
Oh.
suggestions? Do I really owe that much money? Mike from Boston.
Well, I mean, until we look at the return, we can't say, right?
But probably this was a rental commercial property, so he had to pay capital gains on all that depreciation that he had taken for all those years.
But again, I would say the first thing I'd like to do is make sure the return was done right.
Yeah, I was wondering when his wife passed away and was her name on the property.
Right, because if he had sold it after her death, then what happens, like I said, was it done correctly? He would get a stepped-up basis for her portion of the ownership.
Right. And so owing this much money, it's really important to have a second look. And so I would never let this go by the wayside. You should really have us take a second look, because the really important thing is if her name was on the property and you didn't take the half stepped up basis, that could save you thousands and thousands
Thousands of dollars. And the other thing is, for those of you selling investment property, all the depreciation you claimed all those years has to reduce the basis of the property, which means you're going to end up paying taxes on all that depreciation. So let's say you paid $100,000 and you've had it for 30 years and you've gotten it down to zero basis and you sell it for $200,000, you have a $200,000 gain with some tweaks for expenses, sale, and things of that nature.
Yikes.
So one of our partners is Russ Gullo, whose job is he's a qualified exchanger. There are ways to exchange out of this property into another form of investment and not pay any taxes. So you can pay on a $200,000 investment, you might pay 3 times $60,000 in taxes. Or you could do an exchange and get out of it completely. But to our friend who wrote this to us, the email, the first thing I do is give us a call so we can make sure that that basis was done correctly.
Right. Yep.
Yes?
And yes.
Okay.
Definitely. And it is time for a break. They're signaling us.
All right, we're going to take a short break. I'm Esther Gulius, the tax lady. See you on the other side. Hey, I'm Esther Golias, the tax lady from EG Tax. Thanks for joining us. This week, we are not taking live phone calls. We're still chewing up your emails. If you have a question, if this has sparked an interest in your situation, you can call us during the week at 632-7886. You can email us at egtax.com, ask the tax lady. And we'll be very happy to help you. There's no charge for our information, but we're just completely chewing up emails this week, so we're not taking live phone calls. But I think you'll find this interesting because you can see how complicated taxes are. All right, Chris, we got another one. Tiff?
Tax lady, my girlfriend and I just had a baby. She won't be working till the baby's older. I've been laid off since February. My unemployment has been around $25,000 so far. We're making it, but I understand the unemployment is taxable. How much do I need to set aside? Torrance. This is Torrance.
Okay. Well, first of all, because he's single and he has a child living at his house, his filing status changed.
Right,
Yep, that's
right. He would be
Because
head of
he's
household.
now head of the household,
Yep,
right?
yep,
So his standard deduction is over $18,000.
right. Which
So-
means he would have about $7,000 left,
And if he's claiming mama as a dependent,
and
right?
the baby,
and the baby, he doesn't have any liability.
right?
Yay.
But what really is important for him is he should work.
Yeah.
Why?
Earned income credit.
Absolutely right. So I know it must be a wonderful kumbaya moment for all three of you guys to get up in the morning and watch TV, but you're missing out on the earned income credit with your income so low and a child living in your home. So you just might want to go get a job for the rest of the year so that you get that earned income credit and you'd get the refundable child tax credit.
I
So
know.
you're missing out on a lot of money for working.
I know one of my daughters, her friend, just got a job at a grocery store. Lots of grocery stores and BJ's and Aldi's and Tops and Wegmans. They're all hiring, and they're great places to work, and they are looking for people to work there.
Right. So if this kid makes $10,000 working, and so his income's $35,000 for the year, he'll still get the earned income credit. He'll get the refundable child tax credit. He's not going to pay any income taxes. He's going to get a earned income credit on the state. I mean, that's the best thing to do. Otherwise, he'll owe nothing. But if for those of you that had formerly been wage earners and have been on unemployment and you don't have any income because you've been collecting unemployment and you would have gotten an earned income credit, you lose all that money. So it's really, really important where you might have gotten an $8,000 or $9,000 refund at the end of the year because the earned income credit, without wages, you're not going to get anything.
Right. Yep.
So go to work.
Michael says, EG Tax, I have 3 rental properties, and I was thinking of forming an LLC and put my rentals inside the LLC. My lawyer said that they weren't worth enough to do this and just leave it the way it is. What are your thoughts? Are there any benefits to having an LLC? Limited
Primarily
protection.
for lawsuits,
Right.
right? I mean, it's not going to make a difference on your tax return, okay? But it will make a difference if somebody falls and breaks their leg on your porch, because if you don't put your assets that are income producing with some type of protection, then in the event of a lawsuit, then they can go after your assets. So other assets. Whereas if it's in an LLC, the only thing that's at risk would be that rental property. So
Now this guy might want to incorporate instead of doing an LLC, because an LLC is much more costly because you have to do the advertising. Whereas if he incorporated or got more insurance, that might be more cost beneficial for him.
right.
Chris,
But
you
I will
agree?
tell you, with and especially this year, with people didn't have to pay their
Pay the
rent
rent.
because the COVID thing. I mean, it's just going to be very complicated. But the LLC is not a bad idea to protect your assets.
Yeah, it has nothing to do with the value of the properties.
No, it has to
it's
do
due
with
the
whether someone's
protect.
going to hurt themselves in your property.
Right, right.
And
Because
then they go after your personal assets.
right, because you have 3 properties. If something happens, even if you have all 3 in one LLC, and something happens in one of the properties, and they sue you, they could then take over all three of your properties. Where if you had building A in one LLC and building B in LLC number 2 and building 3 in LLC number 3, all they could take is what's inside that individual LLC.
But here's the other thing. For those of you that already have LLCs, but you're not conducting yourself in a business-like
Yep.
manner, you just wasted the money to put it in an
Right.
LLC.
Yep.
Because you have to act as a business in order to have the protection of the LLC. If you start commingling money,
Separate-
you
separate
start taking
accounts.
your family out to dinner on using your rental, using those as an expense. I mean, I don't things of that nature where you're commingling everything, then the veil of the LLC can be pierced and they can go after your assets. So you have to be very, very careful to act like an LLC. So if you're not going to, then it won't make any difference anyway. Get more insurance.
Yes.
Sandy says, EG Tax, my 22-year-old daughter is in graduate school but lives at home. She says we can't claim her because she's working and makes about $8,000. My wife and myself make about $140,000 combined. Can we claim her? I trust you, Sandy.
Okay, so go back to what is she now?
22 years old. So you can claim your kids up to the age of 24 as long as they're
As
in
long as
school
she's a full-time student.
for at least half of the year. Yeah. So she could be claimed as long as they're providing more than 50% of her support.
Right.
And she's going to school.
And she's
full-time.
going to school.
Right. So yes,
it-
she can be claimed.
It sounds like she, if she lives at their home, they're paying everything, the mortgage, probably the
Homeowner's
food, the
insurance.
utilities, everything, so it sounds like they are supporting her. So, yeah, I would say you want to claim her. I mean, there's a $2,000 credit out there. So the daughter would not get it because her income's only $8,000. The standard deduction on the federal for her would be $8,000. So the daughter is saving nothing on the federal. She would save maybe $200 on the state. So, but here the parents are giving away the $500 credit plus the schooling of $2,000. So that's $2,500 to the federal, and then $60. I know it doesn't sound like a lot, but $60 on New York State for the personal exemption. So, I think the $2,560 is better than $300 for the
That's
daughter.
right. I mean, because what it comes down to is the bottom line.
Yeah.
Yep.
And that's one of the reasons why talking to a tax professional is so important, because we know the angles. It's like going to a bar that has a pool table and here's Fats
Domino?
Minnesota Fats.
Minnesota, that's it.
Banking all the things, and wow, they know what the heck to do. And here you come, and here you got your cue stick, and you can't hit the ball right, and your balls don't go in the thing because you don't know what to do. I mean, being with a professional is so important. And I think if you learn anything from these looking at the emails, is that it's just not black and white. There are options, and some of the options that people choose are not the best for them
Right. I know.
by thousands of dollars.
Yep. I know just the other day I had a client come in and she goes, I know I'm going to owe. I got 2 years to do. I'm going to owe. And I did the return and she had refunds coming. And she's like, how did you have a refund coming? I said, well, you have your daughter who's in college. You have the college credit. She goes, TurboTax wouldn't let me take the college. And so, I mean, she was almost ready to accept it. So luckily she came in.
Because in a mathematically correct situation, I mean, these computer programs are going to do it correct from a mathematics standpoint. It just garbage in and garbage out. If you answer a question incorrectly, it's going to do the return wrong. But unfortunately, you don't know that it should have done it this way. It just gives you an answer and go, oh gosh, and it's good to have a second look.
Right. And we do that, if we're not changing your return, if you come in this time of year, we do that free of charge.
Absolutely.
Bring in your last year's return. We'll take a look at it.
Absolutely. Okay, what else we got here?
Jason says, Esther, I'm confused. My father and my financial advisor tell me that I should do Roth 401ks, but I hear you on the radio saying don't do Ross as readily. Can you please help me figure out what is the best for me? I'm 51 years old and I need your assistance.
Well,
Well,
I mean,
if anything, diversify.
well, here's the thing. I mean, it all depends. The first question I'd say is, do you have a pension plan?
Yep.
Yeah,
I mean, like a government plan,
And I
something
would
where.
say
Yeah,
he
Chris?
probably doesn't because it says he has a 401k versus a 403b.
Right. So if you're going to be the person contributing to your pension plan, and let's say you really do a great job and you put $500,000 away, all right? When you go to take it out over a 30-year period, you're probably going to be taking out less than $20,000 a year. Your standard deduction is going to be almost equal to, if not more than, the amount you're taking out. So as a result, you're not going to pay taxes when you take it out. So if you put money into a Roth now, you don't get the deduction now. And when you go to take it out, it's going to come out tax-free anyway. So you beat yourself up on both ends. Now, if you're somebody who has a New York State pension and you're going to be getting $150,000 or $75,000 from your New York State pension or your private pension, and you also have a 401k plan that you would be taking money out of, then it would be taxable, and it'd be taxed at whatever rate that you'd be withdrawing. So a Roth conversion or a Roth IRA might be something you'd want to look at because down the road you would save taxes. But if you aren't going to pay taxes down the road and you're not going to save any money now, you really have to think about why somebody's saying that. It just sounds so good to think that it's never going to be taxed. But if you're losing the deduction now and you're alive now and you can save money now and you're not going to pay taxes later, then I don't think it's a wise thing. Now, the fly in the ointment is what's going to happen in the election.
Yep.
So if the Democrats take control of the House and Senate and all that stuff, they are promising higher taxes. So the tax rates are projected to go up, especially if you have somebody with another pension plan. The Roth starts to look really good. The great thing that we have is the elections in November. They don't change places till January, so you can always do your emergency moving the end of the year. But right now, based on what I know, I would say don't do the Roth.
Right, and Frank's going crazy. We got to take a break for the
I'm
news.
sorry. All right, we're going to take a short break. I'm Esther Golias, the tax lady. See you on the other side. Hi, I'm Esther Golias, the tax lady from EG Tax. We're talking emails. We're chewing up your emails. We're thankful that you're listening to us. I have Tiffany Fabian, Christopher Fabian here in studio. We're not taking live phone calls. We will next week. And let's go with what else we got here.
Patricia. EG Tax, I've been laid off since March. I know the stimulus is tax-free and the unemployment is taxable, but I'm also paying for my health insurance, which is terribly, terribly expensive under COBRA. What if I stop paying? Will I get a penalty? Patricia.
All right, so the easy thing is no, you're not going to get a penalty.
Right.
However, you are penalizing yourself using COBRA.
Yes.
Right?
Yes, indeed.
So, one of the wonderful things that we have at EG Tax is EG Health Connect, and you can call, and you definitely are going to qualify for much less if you're on unemployment, for much less costly health insurance through the New York State of Health. So what I'd suggest you do is give Tim Eliason a call at our office, 632-7886. Based upon your income is what they're going to base the insurance on, and I am going to tell you you're going to save a ton of money. That's number one.
And it's
number
really
two,
good health insurance.
Yes.
I said it's really good health insurance.
And it is really good.
Through the New York State.
How about the premium tax credit?
Yeah, if there's they help pay for your insurance.
Right, but I mean, if she's been paying for her own high deductible insurance, right? Wouldn't she qualify for the
No,
No.
that's only if it's through the exchange. Not through the COBRA.
Oh, that's right.
Yeah,
that's
COBRA.
right.
The
That's
COBRA, that brings up another thing. The COBRA she's paying, if she does have a house and things like that, would be part of your medical expenses. So your COBRA, which could be very costly, could help you bring you up to your medical threshold for your itemized
And if
deductions.
not for the
That's
federal, for the state.
Yep.
Yeah.
But the whole thing is the health insurance through the New York State of Health and someone in your position will be far less expensive, far better. And call EG Tax at 632-7886 and ask for Tim Eliason. He'll help you and anybody else in that situation. And if you think that you're not going to qualify because you have too many assets, many people are going to qualify for Medicaid, I'm going to tell you, and it has nothing to do with your assets. It has everything to do with your income. And if your income's low, it doesn't make any difference if you have assets, not for the Medicaid for New York State of Health.
Right. And
good for her that she's planning and knows it's going to be taxable. What were you going to say?
right.
Chris?
And there is no penalty anymore for not having health insurance.
Esther said that.
Okay, so that was, I can't, how many people came in and I said, oh, there's no penalty. Oh, and the sigh of relief
Of course, there
was,
may be some in January, depending upon the
Right.
election. So.
Yep.
Okay, what else we got?
Henry says, Esther, I just bought a business in March just before the pandemic. It's a breakfast, lunch restaurant. I'm just hanging on by my bare knuckles right now, but I'm hopeful. I took $200,000 out of my IRA to get this. My friends say it won't be taxable. So are they correct?
Well, there's good news and bad news. The bad news is I'm assuming that Henry's under the age of 59 and a half, but maybe not. But if he's under 59 and a half and he took money out of his IRA, then it's still going to be taxable up to, it's going to be taxable. Now, that's on the left-hand side of the balance sheet. On the right-hand side of the balance sheet is how much money has he lost at the restaurant and how much did he pay for it and all the expenses for setup and things of that nature. So if he loses money on the right-hand side, that will help to offset the income on the left-hand side.
Yep. Yep, it sure
But
will.
I have to tell you, Henry, you need to take a look because he can do 179 on a lot of his assets, so that would help him.
He could,
and
if he's paying for his own health insurance, there's an adjustment
and
to
there's
income.
a health insurance deduction. That's
Right.
true, but I think
he had a
you
profit.
you need to come in so we can look at all of your
Yeah. Is he married? Is his wife working?
right.
There's all these items.
Well,
and
The
well,
$200,000 is going to be definitely taxable.
Maybe he,
reduced by any loss that you have on your business. If you don't have a loss on the business, then the whole $200,000 will be just sitting out there taxable.
what were you going to say,
right.
Chris?
I was going to say, this is the EG Tax connection here. We could hook him up with Grace, who started the bakery from last week, and she could do the baked goods for the restaurant, and they could get married. Look we just made a couple right on.
Yay.
But no, yeah, you got to look at everything, Henry. And I definitely come in, bring stuff in so we can do some consultations to you so there's no hidden surprises come next year.
Yep, that's right. Never listen to your friends about taxes.
And
Unless your friend is Esther Gulius.
Barbara says, Esther, my parents just told me that they have a trust set up for me when they pass. Their 50% of their money will go into it for mine and my sister's children to be used for college costs. My children are 3 and 1. My sisters are 5 and 2. What happens in the meantime with that money?
It just grows.
It grows, yep. But every year, a tax return.
Oh, you're talking about taxing. Okay. Yes. All right. Well, that's a horse of a different color. You guys want to explain?
Yeah, the money does grow, like Esther said, just stays there and it grows and it grows. But there is a tax reporting that has to be done just like an individual has to report taxes every year. But the filing requirements are much less for a trust than it is for an individual, where an individual...
And the tax liability is much more.
Yes. So depending how much money goes into the trust, there could be a lot of taxes, or there may not be a lot, again, depending on how it's invested and everything. So every year a tax return has to be done. Make sure your parents are aware of that.
And the other thing is you got to find out if it's a revocable or irrevocable trust.
Right.
Yep.
So if it's an revocable trust, then I would have your parents, I know this sounds terrible, but they might want to take the money out of the trust and put it into an insurance vehicle, because an annuity would grow completely tax deferred. Nobody has to pay any taxes, and the beneficiary would be the kids. And upon their death, they would get that money, and that's when it would be taxable, not before. And some of the annuities are paying a much higher rate. So that's another thing to look at. And an annuity won't affect their ability to get scholarships and financial aid when they apply for college.
Correct. Very
Whereas
smart.
if they had a big trust, it would affect their ability to get financial aid. So that's something else to think about too.
Right. Yep. And yep. I mean, and it, goes with any trust here, not just this one, and estate planning. Make sure all your I's are dotted, your T's are crossed. What happens if one of your children doesn't go to college? What happens to that money that's set aside? That has to be spelled out inside the trust. I know we had a client a couple weeks ago that came in, and mom just died, but mom was holding a mortgage for one of the children, and there were 3 other children. Does that mortgage go to the 3 other children less, so there's a lot of things you got to look at. It's not a simple little estate planning. And I know we just had Jeff Katz on a couple weeks ago, and if you need advice, I know he's a great tool to have in your chest for estate planning.
Yeah, and if you
it
want to,
really is true. Doing things on your own is not a good thing.
and if you want to learn about any of this, I would encourage you to come to our tax school that starts in October, and
Absolutely.
call 632-7886 or click egtax.com to learn about the school.
Okay. We ready for a break?
Nope.
Joy says,
Okay.
EG Tax, I was one of the fortunate, who received the $7,500 for the first-time home buyer's credit, and I'm currently paying it back. I'm looking to sell this house and buy a new one. What happens to the remaining balance of my repayments? Do I have to pay it all back next year when I sell the
All right.
house?
Tell her what's going to happen to her.
If there's a gain,
Uh-huh.
she would have to pay back
Pay it
what
back.
she hasn't paid back. It was over 15 years, so we're almost nearing the end. What do we have, like
5 more years.
5 more years left?
Yep.
Wow.
So, but you got to first, what you paid for it, add in your closing costs, your improvements you've done to that property until you sell it. Then you take your closing costs for selling it. So if then you're left with the gain, then you have to pay back what's left, depending
That's exactly
on if you only have $2,500 left and your gain's only $1,000, they're only going to make you pay back $1,000.
That's exactly
If
right.
you lost $5,000, $10,000 on this, then you don't have to pay any of the remaining back except for the $500 for the year of the sale. So you got to look at the whole picture. It's not just a
I think the only fly in the ointment is that the real estate market is so hot that most of these houses have substantially appreciated. And when you think about it, that was a great program back to tell people to get into their home. And I know it's like, talk about 1,000 cuts every year. They have to pay back that money, but doing the due diligence on your end, where you say, okay, this is what I paid for it. These are my improvements. This is my expensive sale. This is what I'm selling it for, and you may not have to pay back any or all of it, depending upon if you had a gain.
right.
One
Okay.
more question before our break in a minute and a half. EG Tax, I just got a letter from New York State asking for a copy of my W-2s and withholdings. What is this? What should I do? Should I just ignore it? Tony.
Okay, if you don't want your refund, you can ignore it,
Right.
right? But the state of New York verifies your withholding from your W-2, and they will hold up your refund until you comply. So you want to make sure that you you get that information off to the state as soon as possible.
And from the minute they get it, that holds up your refund for another 2 months. So just plan on knowing when they finally get it in their hands, there's going to be another couple of months that you're
right,
waiting.
so the sooner the better. And again, if you get those letters, you can call EG Tax, and we'll help you to answer those letters. But yes, if you want your refund, and I mean, you may not like it, but if you want your refund, that's what you're going to have to do. And like Tiffany says, that holds it up for 2 months.
Right. And this happens to everybody. We've even seen New York State employees get the same letter. So it's just something they do to delay refunds. And this is why we say all the time, change your withholding, get a little refund or owe a little bit. Don't wait for a big refund.
And
That's a really great point. Hey, Tiff, I don't mean to
that's
step
okay.
on you, but that's a really great point. When you're somebody that needs that refund and you're waiting every year for it, and you're waiting for whatever hoops the governmental agencies come up with to get you your money, you have to look in the mirror and say, shame on me. All I have to do is change my withholding so that I send less money to them, so I have a smaller refund, so it doesn't hurt me as much, and you control your own destiny, and that's part of what we will help you with.
Right. Yep.
And I've even seen the IRS sending out more of those withholding letters lately, too.
Yep.
Okay.
And
What else we got?
Now it's time
gonna
for
take a break?
Yes.
I'm Esther Gullius, the tax lady from EG Tax. We'll see you on the other side. Hey, I'm Esther Gullius, the tax lady. Thanks for joining us this week. We're doing something a little different. Next week, we will be taking live phone calls, but this week we're chewing up your emails. I got Tiffany Fabian, Christopher Fabian here in studio with me. And so what else we got here?
Dave from Attica. Esther, I just took a new position at my church as a pastor. This is a brand new for me. I just graduated from the seminary 1 year ago. They asked me how I want to have my pay allocated. I don't know what this means. Can you please help me to understand so I can
Well,
go
actually,
forward?
the allocation of his pay for housing and wages is something that the board would determine, the housing allowance. So when a pastor gets a salary package, they would have a housing allowance and wages. The housing allowance, provided that the pastor uses it 100% for housing, is tax-free on the federal and New York State completely. He does, or she does, has to pay self-employment taxes on the housing portion. The salary is taxable federal, state, plus FICA. So that's probably what they're asking him about. But he would go back to the board and say, this is the cost of my housing, and they would have to approve that. And then they peel off that portion and give him that money per month to pay for his housing, and his wages would be paid per normal.
Yeah, this gets a lot of people, right?
It gets very confusing for pastors. And then how about what if he opted out of Social Security?
Well, that's a horse of a different color. Now, and he would have that option, just getting out of seminary this first year, to say, I have a conscientious objection to the federal government paying for what should be a responsibility of the church, and so therefore I don't believe in federal programs, and he can make an election to not be taxed on his salary as a pastor.
Yeah.
But it's a one-time election. And you can't get back into Social Security. So once you make that election, you don't have to pay FICA.
But then you don't collect it later on. I mean, it's
but
a
then you don't-
hard.
Well, but then again, let's say he had 40 quarters in.
Yep.
If
Prior.
he's an older person, he would be able to collect it later, or he'd be able to get half of his wife's if he has a wife.
Yeah. But if
Right.
no,
So that's something, again, if you're a pastor and you want to look at this, you can come in. EG Tax will help you. So if you make that election right after you're ordained, or you got out of, or you're licensed, you can make that once in a lifetime election. Your FICA would
That
not be
is so
taxed.
cool, Esther, how you said if he already has 40 quarters in or he draws from his wife. I didn't know that was an angle.
Yeah,
That's
I mean,
makes
yes,
sense.
It is.
That's cool. I mean, that's the law, right?
Right. I mean, provided she's got right?
Right.
Yep.
Yep. Nick from Buffalo says, Esther, my father gave me $60,000 to help me pay off my student loans and some credit card debt so that I can buy a house. Is that money going to be taxable when I file my return? Nick,
Is Nick going to be happy?
he's
No.
going to be happy. Now his
No, it's not
dad,
taxable. Anytime somebody gives you a gift, it's tax-free.
right?
So it's not deductible to the payer, and it's not taxable to the recipient. Now, if you had
Now his dad has to do a gift
if
tax
you
return.
had gambling, that's a horse of a different color because
Right.
that's something different, or wages. But if somebody actually gives you a gift, then it's tax-free.
Right, and his dad is going to have to do a gift tax return because it's over the exclusion for the year.
15,000.
15,000.
Yeah.
So if the person, the gifter, the person giving the money, has to do a gift tax return if they give more than $15,000 per person per year, so to adjust his unified exclusion upon his death. But right now it's a gigantic. You'd have to have
Exclusion.
a really powerful estate in order to have to
Meet
pay
that
any
threshold.
taxes in the end upon your death. I think it's like $21 million. So. But again, that's subject to change, as I believe it will if the wrong things happen in January. I mean, in December, in November.
Yep. Alicia
One of
says,
them. One of them.
One of
months.
those months.
Alicia says, Esther, I just moved into the U.S. in July of 19 from Singapore. I was there for 3 years as an English teacher. Do I have to claim the income from Singapore on my U.S. return? I never claimed my Singapore income before. So you taught me a long time ago you have to report worldwide
Well, that's
income.
what it's. I mean, I've only taught you that because that's what it says. You have
Right.
to but she would get an income earned abroad exclusion, right?
Yep,
Right.
a 2555.
Yeah, so if she hasn't done it in the past, she really should amend those returns, put it on. She'll get an exclusion for income earned abroad anyway. But yes, it's taxed on worldwide income.
And then that's you know,
The F bars.
there could be an F bar involved if she
Now,
banked.
don't
on-
go swearing, Chris.
I know. Sorry, Frank. Don't have to hit that dump button. But it's if she had over $10,000 equivalent to sitting in a bank in Singapore, she would have to do.
Or any place. I mean,
Yep.
any foreign country, right?
Yep.
Any foreign bank account.
Yep, she would have to do this foreign bank account reconciliation, or it's also now called a FinCEN. So that you have to report yearly saying this is the highest value and this is the account number, and you list all your accounts. And if you don't, it could be up to a $10,000 penalty.
Or 50% of the value of the account.
Yeah. So
So it's very important. But here's the thing. Let's go back. So she has income earned in China, and she never claimed it before. So what she wants to do is she wants to amend her returns and puts it on. She's going to have income earned abroad. It'll cover it, I'm assuming, most of it. Because it's how much is the exclusion now? 100 and
115,
125?
something like that. Yep.
So that's going to be tax-free anyway. So she's good there. But her income this year, again, is going to be tax-free. But if she has bank accounts in any country outside the United States, she has over $10,000 at the highest value at any time during the year, she would have to do the FBAR report. And failure to do so can affect penalties, and they could seize the bank account,
Right.
take half of it. Okay.
Charles says, as a tax lady, my son will be going to college this year, but he lives with his mom, my ex. I have the right to claim him on my tax return. Most of the costs will be financed. Does this affect my return at all? Well, good news.
Oh my goodness, is he going to be a happy camper?
Yeah, he gets to claim the son,
Which he
as
was
a single
entitled to
person.
anyway, right?
Right. And he gets to claim the college credit too, even if it was financed. But if
Right,
it,
and that's what people don't understand is just because the kid took out a student loan doesn't preclude you from taking the American Opportunity Tax Credit. It's a lot of money. It's with the state of New York and federal, it's like $2,900 it can save you. So this guy may get an extra refund of $2,900 because his kid went to college.
Right.
huge.
Right.
Yep. Big difference. Big difference.
And I can tell you, I've been on the other end, and the mom, who is the custodial parent, she'll still get to claim head of household if she isn't remarried. And she'll do a code 0 for that dependent. But a lot of times those moms are like, I wanted that college credit, or the dads. And so it just leaves a lot of sour grapes lingering around.
Well, and the thing is, to be fair, the dad is usually paying the child support. So,
Right.
and he can't deduct the child support. And now if he's paying alimony after 19, he can't deduct the alimony. So,
Right. Yeah. And don't forget, it's really important that mom still gets to claim head of household, and that dad, who is the non-custodial, will do single with a dependent. And he'll have to get a release of claim form from the mom signed, because that's the law for divorces after 2011.
okay. What else we got?
Sean writes in, Esther, we are looking into solar panels, and the salesman says that we can pay about 25% of the cost after the NYSERDA rebate and the credits for the IRS and New York State. I know the saying, if something sounds too good to be true, it probably is. So, is this too good to be true?
So the credit goes to, it's about 30% on the federal, and
25.
Actually, it's going down next year. I think it's down to 22%.
and it goes to eat up a liability.
But the thing is, it's a non-refundable credit. So if you don't have a liability equal to the amount of the credit, you will only get as much as your tax liability is, and that's the federal and the state as well. So a lot of times, especially retirees who have no state liability, are told that they're going to save all this money on the state and the federal, and they have no liability because they don't have to file. So your savings is going to be limited by your liability. For those, if you had the situation where you didn't have a liability, but you had money, let's say, for instance, in an IRA, that would be a great time to take it out, because the
credit could eat it up.
The credit is going to offset the taxes. So again, it comes down to planning. So the easy answer is yes, there's a credit,
on the federal and the
but
state.
limited to your liability. So in this situation, you want to make sure that you have enough income to take advantage of that credit to get optimum benefit.
Right. The IRS in New York State aren't writing you a check for the 30% from the federal and 25% from New York State. All it's doing is removing your tax liability.
And I'm going to sneak in a quick question before we have to go. Corey says, since I've been working at home, is there any deduction that I can take for these homes' work office expenses while I've been working from home?
This
Really
is an
fast
easy one.
answer.
This is an easy one. No.
On the state, possibly.
No, but but we don't know what's going to happen here. I mean, they might put through because of COVID, they might put through, I know that they've loosened the restrictions on entertainment. So who knows before the end of the year, but right now in August, no.
But on New York State, you can take job expenses.
But on New York State,
potentially.
you can.
Yeah, so you really
You
want
always
to make
could.
sure you look
Right.
at that.
Correct.
And
All right,
don't
guys.
forget to register for our tax school. Call 632-7886 or click egtax.com and register. We would love to have you.
And then any questions you have, you can go to our website at egtax.com, ask the tax lady. Until next week, I'm Esther Golias with Tiffany Fabian, Christopher Fabian. We love helping you. Thank you for listening. Have a great week. God bless.